had to start all over again, I would spend a lot more time investing in property and learning about how to do it correctly. I've lost hundreds of thousands of pounds not knowing how to invest in property correctly. And today we have an expert. His name is Lawrence Dunning. He's a multifamily property investor, and he will tell us about how you too can find the best strategies for low risk property investing. And the first question is, what's the secret to your success and how did property contribute towards that? Welcome to Awakened Titans podcast with Lily Patrascu, mind-blowing conversations with influential business titans sharing how you can manifest abundance, love, joy, success through quantum awakening, quantum manifestation, quantum healing, quantum miracles, exponential business growth, and innovative products and services.
Well, Lily, it's a real pleasure to be here. Thank you for having me. And so I actually came to real estate a little bit later in my career. Before I was trading, and trading is the opposite. It has a lot of volatility and you can do very well, but it's one of the few businesses where you can work all year and actually have a negative year, which is it's a very funny thing to get your head around, because that happened to me. All the years I traded, I only had one negative year. But I remember thinking I could have sat on a beach and I'd be better off financially than I was having been stressed and working all year. So when I actually came to real estate investing, I work as a broker, as a developer. I published a book. I'm all in the real estate world now. But initially, my first exposure was I was a trader who had made money trading, and I was trying to find a place to put it and not lose it. Because when I was young, I thought if you made a lot of money, it was the same skill to make money as to keep money. And then I realized the hard way, as a young man will make a lot of mistakes if he has too much money. It's a very different skill set. You can be good at any one niche that people will pay you for your expertise and you can make money. But to maintain money requires a completely separate set of skills. And if you look at real estate, most of the very wealthy people own vast holdings of real estate. I think the average multimillionaire in the US has about 7 forms of revenue, and often real estate is one of those revenue streams. I would love to ask you though. You said you'd lost some money in real estate. How come? Can you give a little bit of like a summary of how you lost money?
Great question. So I was managing 30 properties for 14 years, and during the pandemic, I was stuck abroad for 111 days. And I was unable to kind of come back to manage the portfolio. So I lost a lot of it. And just because I was unable to kind of rent it, because my partner used to have 6 people before who were doing all the rentals. But because I'm so efficient, I replaced everyone and I was doing everything, right? So it worked out very well. But, of course, we didn't plan for this thing to happen. So, when the pandemic happened, first of all, not so many people were renting because they couldn't move and they couldn't go anywhere. And also the rate of renting was a lot lower. So I was kind of like forced to lose the entire portfolio. And actually, I lost a little bit more even before because of regulatory issues that I just couldn't handle that. So basically, I lost the entire portfolio, and now I have just one property. And what I mean by I lost, I had a model that worked, that was bringing income all the time, and it was a very profitable thing that I was doing. And I do think that if I started this again, it would work just as well as they worked before the pandemic. So it's about repeating the same process, but I would do things differently now, because I realized that we were investing a lot of money in the properties that other people owned. So there was quite a lot of risk in the sense that they were able to anytime, get their property back. And then we had invested quite a lot of time and effort and money in refurbishing the property. So we would add quite a lot of value. So it was actually a no-brainer for them to even keep giving it to us. But of course, most of them did. But some of them took advantage and, took the property back, and they, managed to refinance or sell the property and so on. So we lost on a lot of different ways.
Well, I'm really glad you brought that up, because I also had a tough time during 2020, but it actually wasn't so much through properties that I owned. I had a partnership. I was doing a lot of developments and some big buildings, full gut rehabs. And it was such a crazy time that I think a lot of people generally, if they hadn't faced that kind of adversity before, they just fell apart. And my partner, he used it as an excuse. His wife had some health problems, and he just used it as an excuse to just say, "I'm done," declare bankruptcy, and screw everybody over. So that was a very painful lesson. But it wasn't so much the real estate; it was a bad partnership. And it sounds to me you had that same kind of story. It wasn't really that the real estate as much as you didn't have the ownership of the buildings that you had all that money invested. So the one beautiful thing actually about 2020 was I was very curious to see. I had a bunch of tenants at the time, Lily. I was thinking, well, are they going to pay rent? Am I going to see things that were normally selling for 700,000, 800,000 suddenly selling for 500,000? Are we going to see these crazy fire sales in prices? And what I saw in the US was most tenants, with very few exceptions, with me, with my friends, with my clients, they did keep paying throughout the period. That was really good. The other thing, of course, you do have the odd tenant that will try and take advantage, and even if they don't have hardship, they'll claim hardship. But in general, I was very, very surprised. And the other thing is if the stock market at the time, the US stock market, and I think it was the same in Europe, when the shutdowns first happened, it had this incredible sell-off, and then it had a really quick recovery. They called it the V-shaped recovery. It was really quick. And so that was a lot of volatility. And in all my real estate, it stayed pretty stable. The prices went down a tiny bit because of the uncertainty, and then it just kind of crept up. And before we knew it, it was making new highs. So that was a really positive thing with real estate, is it was very resilient. And actually, I was looking at some data. I gave a presentation yesterday to a real estate group, and we were looking at the last 75 years, how many years had negative years in real estate. And there was two that was less than 1% negative. I think it was in the 60s. It was really, really small, or 60s or 70s. And then, so basically flat. And then you had 5 years between 2007 to 2011 where it was negative. That was the biggest real estate crash, in this century. But aside from that, every other year was positive. So I would say real estate is so much more stable, and it has so much less volatility than other investments like stock market. Like crypto is incredibly volatile. And it's not to say that you can't make money in these other things. It's just that the business model of real estate has a few unique things. And one of them that I really prize is the lack of volatility, because I came from a business that was so volatile when I was young. And that's okay for a young man. You don't have too much responsibilities. But as we get older and we have families and we have mortgages and we have, bills to pay and school bills and health, and we have a lot more, we have a lot less desire to take these risks and have these big swings. So I really like the stability aspect historically of real estate.
Thank you. So you earned the title of top 1% agent in Chicago. You've also sold $250 million worth of properties. So you have quite a lot of experience in terms of property. So my question is, What is the best low risk property investing strategy that you've managed to leverage that other entrepreneurs can leverage right now?
So I think it's there's a lot of different business models that people have with real estate. So for instance, some people like short-term rentals, which is Airbnb. That can be very profitable, but it's a side job. I mean, it's a lot of management. Even if you outsource it, that those management companies are charging you 30% or something. It's very high. So the business model that I found that worked really well for me and for my clients is residential multifamily. You in a city, in most places that have dense housing, there's always going to be housing needs. And as long as you market things pretty well and you're reasonable with your prices, you'll never have more than a few weeks vacancy between tenants. And so I found that business model works really well. There's a few things you can do to be a bit more. You can be a bit more speculative on the areas, and you can be a bit safer on the areas. And in general, as you go to the more speculative areas, you do get paid for that. You get a higher return because you're taking the risk. But there's one business model that has worked really, really well for me. It's finding an area that's close to downtown. So you always have people that are going to have to commute. There's a lot of work downtown, and close to a medical district area. So in Chicago, there's a medical district. I think it's one of the biggest in the country. Rush Medical District. It has 45,000 employees associated with the hospital in multiple locations. So anything within a 3-mile radius of that, you're going to have a huge built-in tenant pool. And at the same token, that same area also has close access to highways that go downtown, has train lines, has a lot of nice restaurants and things that are just starting to get developed. So if you go into an area that's really nice, you're never going to make any money because the prices are just way too high. And if you go in a really bad area, then you're going to be dealing with a lot of problems like higher crime and difficult tenants and evictions and all these other issues. So you have to kind of go in the borderline areas where you can see things are changing. And that's the biggest advice that I can give everyone. And you can go somewhere and you can drive around for a few hours and talk to people, and you can learn a lot about an area just in an afternoon research. So I always advise people is if you're investing remotely, then you need someone on the ground like you or I who can tell you this stuff. But if you live locally and you want to invest locally, even if it's a few hours drive, spend a day and do some market research and walk around and see how these areas feel as you go from a good area to a bad area, and try to see some people, because you're always going to find in a city, you're going to find some projects that are getting developed. You'll see the skip on the street as they do things, the Tavaric wrap on the buildings as they're doing things. So you can do a lot of research. I could take someone in Chicago for an hour and a half, and I could show them so much about an area just by walking around and pointing things out. So I think that idea of just doing a little bit of market research, if you can, if you can't, rely on someone who can do it. But it goes a long way.
Thank you. Is there a reason why you were investing in Chicago? Is it because you live there?
So that's actually a really good question, Lily. So I got very lucky because I happened to get into real estate and I was located in Chicago. But Chicago historically has good returns. So a lot of my clients, they're from all over the country, Texas, California, New York, Boston, from all over the country, and they can't get the returns in the areas that they live because the prices are just too high. So the Chicagoland area is kind of the sweet spot of the country where historically it has the price you can buy buildings and the price you can rent the units out for. The math works. So it works for investors. So the returns tend to be higher around where I live than all these other big cities in these popular areas. So I always laugh about it. I say, I just got lucky because I started going, if I was in a different area of the country, I would probably have to find a different niche in real estate. I wouldn't be doing multifamily and investors because they're all looking to invest where I live in Chicago.
Thank you. Tell us, what exactly is a multifamily investment? Is it like that you buy a building that has multiple apartments? And
exactly.
Yeah. Okay.
Yeah. So typically, the way it works it might be different in Europe, but in the US, anything 4 units and below is considered, if it's residential, it's a different type of loan. And say it's a 10 unit or 20 unit building, even if it's residential, meaning you have 20 units with tenants you can rent out, it's a different type of loan. So most people in Chicago, the sweet spot is new construction 3-unit building is going to be about $800,000 to $900,000, and it's going to make between $600 and $7,500 a month. So if you do the math, that's a really good return. So that's kind of the sweet spot. So every time it's not that when builders build or they do rehabs, they're working with existing lots, city lots. And the restrictions in Chicago tend to be for a standard Chicago lot. You're going to build a 3,900 square foot building. It's going to be 3 units. Each one's going to have a floor of about 1,300 square feet. So that's kind of the most common building that I'm selling is these 3-unit buildings for investors, because that's just the way builders build in Chicago with it. Because it works for the investor, it works for the builder, the numbers work, and it works for the zoning of the city. So wherever you're developing, wherever you're doing real estate, every area is going to have different restrictions. And of course, you have to abide by those restrictions.
Thank you. So tell us more about how it works. Imagine that I'm an investor and that I want to invest in Chicago. So what's the process and how much do I need to invest? What's the minimum? And what are the potential returns? I know you cannot make any guarantees. And why is that a good strategy over other strategies that exist in the market?
Sure. Well, so in Chicago, typically, so if it's someone who's not living in the building, you're typically buying with 25% down. So that's the good thing about that is, say an $800,000 building, you have to put down 200,000. So that is a lot of money, but at least you have 4 times leverage. So if it goes up even just 3% in 1 year, because you've got the power of leverage, you can actually make 12% on your down payment, right? Because you only put down a quarter of the price of the building. And then on top of that, so the reason real estate works so well, the business model, the multifamily model, is because once you get all your rents and then you minus all your expenses and then you pay the property manager, you're still left with cash flow. And that's kind of what I was saying. Some of these other areas, whether it's New York or whether it's Texas or whether it's California, they have negative cash flow, meaning if you or I bought a building with 25% down and we collect the rents and then we pay all the expenses, because the prices are higher, we're going to be losing money every month. Whereas in Chicago, you're going to be making money. So you get the cash flow, you have the appreciation. Historically, things appreciate over time. Every month when you pay your mortgage payment, some of that is principal. So they call that debt pay down. You're paying down the debt, so your equity is going up over time. So that's the three ways you're making money. And then the fourth way, for anyone who they pay taxes, you have tax write-offs. The biggest thing in America is you get all the tax write-offs. So I'm not sure if you were out of the country how that would work, but if you're a local investor, you get a lot of tax write-offs when you do your taxes. So that's money. You get the three ways of making money on the front end, and then the tax write-offs on the back end. So typically in Chicago right now, even though interest rates have gone up a lot in the US, you can still make for the right building, you're going to make probably about 6% cash flow, which isn't very much. But don't forget, that's only the cash flow after you pay your expenses. You're also paying down your debt every month. You're also having some appreciation. So in real terms, it is 12 to 20% a year appreciation or something like that. So it's not like crypto where you can make 20% in a week, but it's very volatile. But it's still a slow and steady way where even in this high interest rate environment, you can make returns. And the situation right now, most people that are buying, like I just bought a building a few months ago, my interest rate was 8% for an investor loan, which is very, very high. It's terrible. But I know come in the spring, I'm going to refinance that probably at 5%, and prices will most likely, I'm pretty optimistic that they're going to be higher come the spring, because as rates come down, the pool of buyers becomes much higher. So I'm not quite sure. Again, I think you're in London. Is that right, Lily?
Yes.
So I know it's a bit of a different market in England as it is in the US. But in the US, every 1% that interest rate comes down, there's 5 million more buyers that can now afford to buy. Right now, they can't get the loan because rates are just too high. So I think it's just the simple formula of the supply and demand aspect. You're going to have so much more demand that's going to come out as we see interest rates come down into the spring of next year, that the prices are going to have to creep up in order to keep up with that demand, because we just don't have enough inventory. So the US is dealing with ever since 2008, 2009, when they had the big real estate crash, all the metrics of builders nationally has slowed down. So you have less and less inventory, but you have all this legal and illegal immigration. So you have all these people coming and they all need housing, but you've had a decade and a half of builders slowing down. So we're coming to a stage where there's going to be a big shortage of housing, and that's another reason why I think prices are gonna go up a lot the next year.
Thank you. Are entrepreneurs able to pool their money together in order to buy some of these property deals that you have, or do they have to buy their own project individually?
Yeah, so the way it works with lending is you can have several people that pool together and they buy, and then they put it into an LLC and they have joint holdings in an LLC. But it's a bit more complicated. And that's a great point, Lily. So I think the biggest barrier to entry, I think real estate is a great tool, but the biggest barrier to entry is just the big amount of money you need if you're an investor. If you're buying with 25% down, you need these, a huge amount of money, 220,000 maybe for a building. Whereas you can have 2,000 and you can put it in Nvidia stock, and you can have 1,000 and put it in Ethereum, and you can have these other investments they require. You can put small amounts in to invest. Whereas real estate, I think the biggest hurdle for people is just a big down payment for that for the purchase for a building.
Thank you. Can you take us through other property investing strategies that you've tried that perhaps are not as exciting as this one, and why not?
So I'll tell you, so a lot of people like the idea of commercial tenants. And the first building I bought had commercial tenants. And it's great because when you have residential tenants as a landlord, as an owner, you're responsible for maintaining the units. Meaning if there's a problem with the plumbing, you have to fix it. If there's all these lights that go out, you have to go and replace that. You have to do snow maintenance in the winter. You have all these rules that tenants expect the landlord to do. Whereas with commercial tenants, they rent from you and they're off. That's their job. They take care of everything inside that unit. It's on them, so it's a lot less maintenance. You're not going to hear from people. So the first building I bought was a commercial building, and I thought it was so great. These tenants were great. They tend to stay for many years. They don't leave every year. They can be there 3 years, 5 years, 10 years. And so it's great until it's not great, because when you have a vacancy with commercial tenants, sometimes it can take a year or two to get the space filled, especially if it's an unusual space. So I'm having real trouble right now. The first building I bought, it was great for a long time, and then one of my tenants grew out of the space. They needed more room for their business, so they left. And I've been trying to fill the space since December, and it's been really challenging because it's a very unique space. And even though it's a really good area and there's a really busy road by, so you have a lot of through traffic, which is great for business, it's been really, really challenging. So that was a very painful lesson that I learned the hard way. Is it's, to have a building with these national tenants, like I had a Firestone Tires, a Subway. These are national tenants in the US. It's great. It's great until it's not great. So right now I've realized that if you can have residential units, you can always find people to rent them in an area where there's, the population's above a certain amount. You'll never have big vacancy. And for me, for real estate, the biggest killer is when you have a vacant building. So you have all your expenses that you're paying, but you don't have the income. That's when you start to run into problems. So I think the most important thing is making sure that you're always going to have cash flow. And that way, it doesn't matter if there's a crazy time where there's no buyers. Say you couldn't sell your building for 2 years because there was just no buyers in a certain area of the country where you're in. It's okay, because you can still rent it out. You can just wait out these bad periods in order to wait for the market conditions to be better. And then you can sell it at a better time.
Thank you. What does the condition of the building, what does it tend to be like? Is it like luxury? Is it like middle? Is it, what's the typical condition?
Great question. So for new construction, even in these bad areas, they're actually really nice units. They're very modern, updated, wood floors throughout. They have really in-unit laundry, quartz counters, stainless steel appliances. They're very, very nice units, because that way you can maximize the rental amount. So it seems kind of counterintuitive, because a lot of time in real estate, they say location, location, location. Don't worry about the building if it's in a great location. But if you're thinking about income, it's actually the opposite, because you'll have, in a bad location, if you have a building with 3 or 4 really nice units, you will have people with money that for some reason want to be in that area. Maybe it's close to work. Maybe it's close to family. Maybe they have friends there. They grew up there. They have ties to a neighborhood. So they'll pay more to be in a really nice unit in a bad area. So for cash flow, the quality is very, very important. And especially if it's new construction, a good developer, he can build a unit, and it's not going to be, how can I explain this? So if you or I we were doing a really fancy bathroom for our home, you could put $50,000-$60,000 in a bathroom, and you can have like marble, and you can have all these crazy expensive materials that make it really expensive. But these developers, they can do a beautiful bathroom for maybe, I don't know, $8,000. So it's not that they're not wasting their money on very expensive materials, but they can still make it look really contemporary and modern, and it's going to be very attractive to a potential tenant. So I think the good developers, they're very smart about how much they're investing, and they're not wasting money on a lot of people that do very expensive rehabs and development and construction. They don't have to spend as much as they do on they're importing tiles from Italy. Well, listen, you can get really nice tiles from down the street. They're not Italian, but they're still really nice, So there's ways you can do things that it looks almost as nice as a similar development that's going to cost 4 times as much or 5 times as much. So I think that's the key, is making it look really nice and modern and chic, but not going above and beyond, because you're never going to get a return if you're getting your tiles from flying them out from Italy, you're importing, you got to try to stay local and keep the material cost low, but that doesn't mean it can't be nice.
Thank you. What's the benefit of using the multifamily unit strategy versus just buying one unit?
Great question. So if you think about just the physics of it, if you have, say, we'll do 2 comparisons, whether it's separate condos in a condo building or whether it's separate single family homes. There's 2 issues you have. If it's condos in different condo buildings, like high rises, the problem is you have these managed fees in high-rise buildings in the US, and those fees will kill your return. So it's very difficult to make money as an investor on individual condo units, because You have to pay for the unit, so you're going to have the costs associated with your loan. You're going to have the tax, which you're going to have anyway. But then you have this, they call it a HOA, the fee of the building, and that can be anywhere from, you know, $500 to $2,000. So it just kills your return because it's this extra fee. So then you say, okay, forget about condos. What about just why would I buy a 3-unit building as opposed to 3 homes? And the fact is, if you think about just the physics of 3 buildings versus 1 building, you have, if with 3 different buildings, you have 3 sets of roofs you have to maintain, and you have 3 sets of exterior walls. And so you have a lot more in terms of the maintenance cost of individual homes versus a certain amount of buildings together. So with a building, you could have a 2-unit, a 3-unit, and a 4-unit. The returns tend to go up as the units go up because you just have more units sharing. You only have 1 roof to maintain, but you have 4 different tenants paying rent, as opposed to if you just had 2 units, you only have 2 units and you have 1 roof to maintain. So the numbers, the more units you can add, the return in general tends to go up to about 4 units. And then for whatever reason, and I couldn't tell you why, as the units get bigger, you would think the return should get bigger, but it doesn't because the prices tend to go up. So the bigger buildings, they have, like I said, they have different loans and the returns don't necessarily go up. So you have what's called the sweet spot where the numbers tend to work with, 3 to 4 unit buildings tends to be the perfect sweet spot.
Thank you. What's the difference between your multifamily unit strategy and Airbnb?
Great question. So Airbnb is short-term rental. So short-term rental will make you more money, but you have associated, you have some different risks, I guess, and a bit more work. So for instance, I have a short-term rental. In the summer, I make way more money than I'm making 3-4 times my mortgage amount, and I'm making way more than I would with a yearly rental. But it's on a lake. So in the winter, suddenly there's almost no demand. So you can have a couple of months with almost no one staying. So the income is a lot less guaranteed. Whereas if you had a year tenant, you don't have to worry in July that you're going to make your rent in August, September, October, November, December, because his lease runs through till the next year. So you have a bit more risk in terms of your income isn't guaranteed, and it tends to be very seasonal. The other thing, COVID, let's take COVID as a great example. During COVID, people still needed a place to stay. So the regular year leases were fine. But the short-term rental market got absolutely destroyed because suddenly people weren't traveling. So a lot of Airbnb is associated with travel, and suddenly these people had, months and months and months of vacancy. So that's another factor. And then there's the issue of kind of, I guess they call it wear and tear on the building. If you have people coming every couple of days, maybe they're partying harder and they're gonna put a lot more wear and tear on the building. So some people don't like that. And actually in Chicago and the surrounding areas, a lot of these buildings have restrictions against Airbnb because the other, say it's a 4-unit building, even if it's 4 separate owners of the building, it's not one owner, it's 4 separate owners. Sometimes they all get together and they say, listen, we don't want to have any Airbnb in this building because it's going to mean people are coming and going all the time. We don't vet them. It could be extra risk of crime or there could be something shady going on. We don't know who they're going to be. So they just say, we're not having Airbnb. So we've seen that a lot in Chicago where more and more buildings have just said absolutely no Airbnb. But having said that, it's still a really great business model if it's in the right location and if there's a reason for it. So for instance, in Chicago, there's a train line that goes from the airport to downtown. So anywhere along that train line, if you have a place that's a 2-minute walk maybe from there and there's no restrictions, maybe it's a single structure, so it's just one unit, you could Airbnb that because it's not going to have any restrictions. It's going to be perfect. People can come in from the train. They can get the train downtown. They can walk around. Maybe it's a nice neighborhood. And maybe the numbers would work even after you have to pay a property manager 30% to manage it. So Airbnb is a great model, but it's the amount of units that it works for, it's just very, very small because it has to tick all those boxes.
Thank you. What I found with Airbnb as well, for me, was that it was very annoying to manage that. Also, everyone has different requirements. And some people are like so happy and they leave you a 5-star review. And then there's some idiots who come in and then they use the facility for 2 weeks. And then they They ask for a refund for something tiny because they know how to play the system.
I was just
You
going to
know?
say play the system. Yes, exactly.
Yeah. So
And
it's
Lily,
like, if it really was so bad, you could have left in one day, like you could have, made the bad review immediately and said, you know what, this is a bad place to stay and therefore I'm not going to, and, ask for the refund. They could have done that. No, but they stay 2 weeks and then they ask for a refund.
I know exactly what you mean. Unfortunately, one thing about real estate is you deal with a lot of people, and you do deal with some wonderful people, wonderful tenants, and then you do deal with exactly what you said. People just trying to game the system and taking advantage and things like that. And it's I'm the type of landlord where if I have a tenant that calls and says, "Hey, listen, I just got a job in Florida and I break my lease and it's November and I know it's a terrible time for me to get tenants." I'm a nice guy. I'll always let them out and be a good person. But a lot of people, a lot of landlords will say, absolutely not. You signed a lease and that's it. So it's a lease does give you a bit more protection. And Airbnb, definitely, we're having the same issue with ours where we explain, where to park and this, and, we give them instructions for everything. They don't read them. They park in front of the neighbor's driveway. Then the neighbor calls us up and like they're complaining that people aren't reading, So it's definitely, you have a lot more of I call it the human element that just causes a bit more drama. But I always say, Lily, that I think in many ways the market is an efficient market, and what I mean by that is, yes, you have more wear and tear on the building, and you have more of the human element, and more headaches and more things to manage. But in general, you get paid because of that. You'll make more in a short-term rental than you would for a year rental. But a year rental is going to be a lot less management. So that's why whenever I tell people, I always say, like, if you want to invest in real estate, the more information you give me, the easier it is for me to help you with the decision. So if you tell me exactly how much you want to invest, what is your timeline, what are your parameters? Do you say, listen, I don't care if I have lower risk. I want to be in a really good area where I never have to deal with crime. That's going to be a different investor to one that says to me, I'm very risk tolerant, and I want to be in the roughest area that I can get away with, where I can still make money, and I don't care if bullets are going through the windows, which happens in Chicago, sadly, and they deal with all this craziness because they're just so aggressive in trying to make the income. So it really is, there's so many things that you have to think as an investor, what is more important to you, and that's gonna determine what kind of real estate investment you go with. So I think that's kind of along the lines of spend a bit of time, if you can, if you live in that area, spend a bit of time doing research where you just walk around, you have a feel for an area and say, I really like this area, I want to buy a building here. Or you say, I don't have a good feeling about this area, I want to avoid it. That same taking the time to do that, also take the time with yourself and think or write down, what are my objectives and what's more important to me? Am I investing in real estate to maintain my wealth? Or am I really trying to grow my wealth? And that's two very, very different business strategies. The big thing with real estate, I'll give you a wonderful story. The first multimillionaire in the US was called John Astor, and he was a fur trader, and he took all his fur trading profits and he bought Manhattan real estate in New York before Manhattan was so well known. And then as the prices started to go up and New York started to grow, he became America's first multimillionaire. 4 generations later, his great-grandson was called John Astor IV, and he was the wealthiest person to drown on the Titanic. So that shows you that when you have when you have real estate, you're creating a legacy amount of wealth that will pass through generations and will just keep growing. So that aspect of using real estate as a tool to just maintain your wealth is very different from saying, hey, I'm young and I'm hungry and I want to take the risk and I want to make money through real estate. That's going to be a very different type of real estate. So I think just the more you can ask yourself up front, the easier you're going to make the decisions.
Follow us for more interviews with world's most influential business titans, providing you with the insights to awaken to your full potential so you can get paid to be yourself, find true happiness, and manifest anything you desire.